kia ora, na mihi nui kia koutou katoa, no mai haere mai kia tēnei hui. Welcome to Investing 101, brought to you by Sharesies. And at Sharesies, our purpose is to create the most financially empowered generation. I'm Brooke, one of the co-founders, co-CEOs at Sharesies, and I'm coming in live from Whanganui-o-Tara. I see a few of you are coming in from Tauranga to all around New Zealand, and someone even said Mars, so there's a thing. And here I've got Gus too.
And I'm Gus, streaming in from Wanaka, and I'm Head of Investments at Sharesies. Before we get into today's discussion, we have a small legal disclaimer. Investing involves risks. You aren't guaranteed to make money, and you might lose the money you started with. Any information we provide is general only and current at the time. If you're looking for help with your investment choices, we recommend talking to a licensed financial advice provider, and we won't be providing any personalised advice as part of this webinar.
Yeah, and also just a real quick reminder, if you have any questions for us, please submit them in the Ask a Question button down below. Try not to leave any questions in the discussion area because we may not get to them. We do have a lot of questions, so we might miss your question, and in that case, we will try find a way to get to it at another stage. We did have a lunch money episode last week with Leighton, Sonia and I, where we covered a bunch of things where we may have answered some of those questions we don't get to cover today. And also you can always go to help@sharesies.com if you've ever got any questions that you need support with. And
finally, please be kind and respectful towards your fellow viewers, otherwise we'll take steps to remove you from the webinar.
Cool. So hopefully we don't have to do that. And now it's so awesome to have everyone here. Today we're going to try get through some key concepts in the first 20 minutes or so, and then open the floor up to answer some of those questions that we're getting coming through. So thanks so much to all of you that are putting those questions in ahead of time. So here's a bit about what we're going to cover today. We'll do a really quick intro on what is Sharesies, why invest, then we'll go into those key investing concepts talked about, open the floor up from there and see how it goes. So to give you a little bit of context about Sharesies, we started Sharesies just over 4.5 years ago because we really believe that everyone deserves an equal opportunity to grow their wealth, and so our purpose is to create the most financially empowered generation, and we do that by giving someone with $5 and $5 million the same investment opportunities. It's great. Since we've started, we've got over 430,000 investors on our platform who right now have over 1.6 billion invested through Sharesies. And, you know, Gus and I are just two of the representatives from Sharesies. We've got this incredible team behind us that are building our wealth development platform based in Whanganui-o-Tara, Wellington, Tamakina Koto, Auckland, and also Sydney, Australia. A team of about 160 now, which is super exciting.
Awesome. So why invest? People generally invest with the aim to grow their wealth. A general rule of thumb with investing is that to earn more, you need to risk more. Putting money in the bank is pretty low risk, but you pay for that low risk when you get a lower interest. Investing in shares generally pays a higher return than putting money in the bank, but there's a higher likelihood that your shares will lose some or all of their value. It may be tempting just to stick your money in your savings account. After all, you know you can get it whenever you need it and you'll get paid steadily, but relatively low interest rates. This is probably a good approach if you're intending on using the money soon, for example, for an emergency account. But if you're saving your money for the long term, you can get away with taking a little bit more risk. Over the long run, taking more risk will likely give you higher returns. This is the key reason why people invest.
Yeah, kia ora. And we also asked a bunch of our Sharesies customers, like, why do you invest? And I thought we'd share some of the key reasons. So some, about quarter, 25%, are investing for their retirement. Half are to get a higher rate of return than what they'd be expecting from a bank. A few really just want to make sure that they're feeling financially secure or increasing their financial security. There's a bunch too that are investing for their children, their whānau, their hapu, which is really exciting in the future there. And some have a really specific goal, like I'm saving for a house, I'm saving for a holiday in Aotearoa at the moment or at some stage when we get out of lockdowns, or saving for a car. And it's the important piece here, though, is that the reason why to invest can differ for each of us, and that's totally normal and what you'd expect too. So having a rough idea about why you want to invest will not only help you create a great investment strategy, but also help you stick to it too when you're like, hey, I want to invest for these reasons, even if it's just to get knowledge too about how this world works and learn as you go. That's ka pai, that's awesome. So that's a little bit about why people invest.
And on Shareises, you can invest in 3 types of investments. So we have companies, exchange-traded funds or ETFs, and managed funds. We're going to go through each of these now quickly. So companies. Companies is when you have a share in a share is a tiny slice of ownership in a single company. So when you invest in shares of a company, you become a part owner of that company. When the company does well, those profits flow through to you as an investor or shareholder, as you're called. And these profits flow right back to you as a shareholder, and this is called a dividend. It is one of the key ways to make money from owning shares. The other way to make money from owning shares is a capital gain. This is when you sell your shares for a higher price than what you paid for them.
Thanks, Gus, talking about companies there. And so if we talk about exchange-traded funds, or WTF as an ETF, as we like to put it, I thought I'd just touch on what is a fund. So we've talked about individual companies that are out there, and then we've got these exchange-traded funds. So what is a fund? A fund is where you have someone called a fund manager who pulls a lot of investors' money, and that manager goes out and invests on your behalf based on some kind of investment strategy or a criteria around what that fund should invest in. So for exchange-traded funds are a type of fund, and specifically ETFs are designed to copy the performance of some type of theme, maybe an index or market. So to give you a highlight there, the largest 50 companies in New Zealand, there's an ETF called the NZ Top 50, which tracks those companies. You can also get themed ones, which might be about robotics or clean energy, and they generally do this by investing a little bit in a lot in a bunch of companies. So like shares in companies, units in exchange-traded funds are traded on the exchanges. So an exchange is like the New Zealand Stock Exchange or the Australian Stock Exchange or the 3 US exchanges we provide through Sharesies. And with an ETF, the key difference to buying shares in a company is that you are not buying a slice of one company with the exchange-traded funds. You're actually buying tiny slices of loads of different companies. So the benefit of this is that it's an easier way to spread your money across a number of investments and diversify your portfolio. Bit of foreshadowing there for what some key investing concepts we're about to talk about.
So the third one is managed funds. So managed funds are a bit like ETFs. They're also a fund, and there's a fund manager who pulls investors' money and goes and invests in lots of different things. But unlike an ETF, the managed fund is trying to beat the performance of some type of market or index. And so the fund manager is actively managing. They're going out and trying to pick the best companies to be better than the average than the market on average. And they'll do this to try and give you a higher return than the market or meet some kind of investing strategy. So some people like to invest in ETFs and managed funds, or a lot of our investors, in fact, because it's an easy way to spread your money across a wide range of things and have someone else make the investment decisions for you. You as the investor just need to do your research into which manager and style is best for you. So you're here, you're signed up, but how do you get started? Firstly, to get to this point of being here, you've already made it further than most. We're going to talk about 3 concepts that really underpin investing, and then ways to ensure that you can incorporate them in your investing strategy so you can aim to achieve your investment goals.
So the 3 key investment concepts we're going to start with diversification, dollar cost averaging, and compounding interest in returns. So let's kick off with diversification. We touched on it just before, but diversification is when you invest in lots of different things and spread your money around. It's essentially, if you've heard that saying, don't put all your eggs in one basket, it's essentially helping do that. So the reason why we do this is to make sure that we're not taking heaps of risk in one area. So if we unpack that a bit, let's take an example of, given this COVID-19 world. So some airline companies have been really impacted by the impact of COVID-19 and obviously reduction in travel, being able to travel. So companies like Air New Zealand, American Airlines and Qantas, if you invested in them just before COVID-19 to now, you might have seen a bit of reduction in their share price since that time. But on the other hand, there are other companies that have actually really been able to grow through the COVID-19 outbreak we've been having, and so those companies have been able to grow, and obviously their share price has been able to go up. So diversification is important in terms of making sure you can get exposure to different elements of industries or markets or even sectors that are performing differently at different times, and it helps you essentially spread that risk around. And then in terms of dollar cost averaging, we thought we would just show you a little video to talk a little bit about that.
So I first started investing, it was about 2 years ago. I felt excited, but then I also felt very nervous and fearful. I guess I was worried about not wanting to lose my money, which is something that went through my mind. But also, I think I wanted to get heaps. So I was told about this way of investing where instead of worrying about the price of an investment and getting kind of hung up on that, you just pick an amount you want to invest and then the things you want to invest in. And the most important thing is that you stick to it. You just commit to that regularly. And what it means is that because you can't pick the price of investments and you can't tell what they're going to do, sometimes it means you buy it when it's a low price. Then the next time you go to buy it, it might be high. And the next time you might go to buy, it's low again. But overall, you've kind of averaged out, and it means that you're not kind of caught on whether buying all your investments when it's high or buying it all when it's low, which would be cool, but really hard to plan if you do. But it means overall you get the benefits without having to have the stress of wondering whether you're getting it right or doing heaps and heaps of analysis every time you want to invest. Turns out it has a name, and it's called dollar cost averaging, and it makes complete sense once you think about it because the price that you're paying is averaging out. Did I say dollar cost averaging?
You did. You sure did.
Hey, thanks, Sonia. So the third concept I want to talk about was compounding interest or returns. So firstly, a simple return is when you make a percentage return on an investment. So if you put $100 into a bank account that pays a 1% interest rate, you'll get $1 at the end of your first year. However, if you were to leave that interest in your bank account for the second year, you'd earn interest on both your initial deposit and on the interest you made in the first year, interest on your interest. Now, if you receive a dividend and then reinvest that money, you'll get dividends on your dividends the following year. So it's the same as your bank account as with your investments. It's the same concept with investing. By leaving your money invested, you start to earn returns, not just on your initial investment, but also on the returns you make along the way, all those dividends. This concept is shown on the graph. In this case, someone is investing $50 a week. Notice that the dark area curves upwards. This is the effect of compound interest. It's like a snowball turning into an avalanche, or an acorn that grows into a forest of trees. Over a long period of time, your investments can build up. Your money is working for you. The other thing that I'd note about this graph is that because of the compounding, time in the market, so the amount of years spent investing, is better than timing the market. The pink area represents someone who has started investing each week at age 28, while the light pink represents someone that started investing at 48. As you can see, generally, the earlier you start investing, the more compounding plays into your favour.
Yeah, it's so important the key thing there is realizing that time is the most valuable aspect of money. And so I think there's like a saying, somebody was saying the other day, like, when's the best time to invest? 10 years ago? When's the next best time now? And it's really taking into account that compounding returns aspect. So while we're here, there are heaps of aspects of the Sharesies app that we'd love to show you, and see that there are some questions about that too. But I thought I'd just take you through a few things around what we provide in the app when it comes to investing. And one is Auto Invest. So what is Auto Invest? Auto Invest is a way that you can set up investing regularly. You can pick one of our pre-made orders and the amount that you want to regularly invest. So you can create your own DIY order from a range of New Zealand funds available on Shareises. So it's super easy to set up in Shareises, and there's thousands of investors who invest through Auto Invest every week. And they do this probably for about 3 reasons. One, it allows you to diversify your portfolio over thousands of different companies through funds. Second, it allows you to dollar cost average, and that is averaging out the ups and downs, because you say, hey, I want to put in X amount every payday, and it invests then. And also means that you can start investing easily now and sit back and kind of let the compounding work for you. So here you can see on the screen a bit of an example of the kids order that we've also got. So if you're a well-meaning adult with a kid in your life, you can also set up a kids account and set up a kids order for your the children in your life. And I've done this for my kids, and it's incredible to see how it grows over time. So I've also seen questions around, well, what's the minimum we can invest? And at Shareises, as I said earlier, our vision is to give someone with $5 and $5 million the same investment opportunities. And that's why on Shareises, we have no minimum investment. Literally, the minimum investment is 1 cent. With our Auto Invest, the minimum investment is $5, and you can choose how regularly you want to be contributing that regularly.
Cool. Next piece was, what does the typical portfolio look like in Shareises? What are other people doing? And so what we see is about $4,000 is the average size of a portfolio, but however, these range from cents through to millions of dollars. So there's lots of different types of portfolios out there. The average auto invest we see going is about $40 a week. However, you can auto invest any amount from $5, and we've got thousands of people who do that. So a cup of tea a week. The average investment portfolio holds 4 companies and 3 ETFs. And what we see is having this mix of companies and funds in your portfolio can kind of give you the best of both worlds. Diversification through the funds buys lots and lots of little slices of companies, while people also get the opportunity to invest at the companies they believe in as well. So the diversity, and also getting to pick things that they believe in. And to show the amount of beliefs that we have, and interest and diverse interests we have through our customer base, our investors hold 6,535 different companies or funds through Shareises, and that's, as Brooke said before, almost $1.7 billion worth.
Yeah, cool. So we've covered why invest, what you can invest in, and some investing concepts. Now we want to kind of dive into, but how do you choose what to invest in? And I really want to know, it's really personal and individual to you. And there's kind of 3 concepts we'll talk about here. So we'll kick off with risk and reward. So all investing has risk, and it's not necessarily a bad thing. It just means it's something that you really need to understand and be comfortable with, and choose what your individual kind of risk appetite is. Generally, the higher risk you take on, there's potential for higher reward, and obviously higher downside too. But that also means you need to be willing to accept that less certainty. And it's important to understand your risk tolerance and manage those risks through things like diversification and investing over the long term. So as part of this, it's understanding when you'll need your money. For example, with a higher risk investment, where say you're picking if your investment portfolio, say the really high risk is just one company, for instance, investing over the long term gives you more time to ride out the waves and ups and downs of that market. On the other hand, if you're wanting to need your money sooner, you might want want to be considering more of a lower risk strategy, so that you're like, okay, the price might be less volatile, so I have more certainty over, or I'd feel like I could have more certainty over how much I should be expecting to get out if I need my money sooner. But as we say, all investing involves risk, and it's quite important to understand that risk and reward. And in the Sharesies app, you'll see that all of the investment options that we offer are rated from 1 to 7 in terms of their risk profile, and you can also see how your portfolio risk is looking by in your portfolio. You can select the risk filter and see kind of where your risks are sitting with your portfolio. The other key concept here to know in terms of choosing, what should I choose to invest in, is what are your goals and values. Considering your goals and values can include asking yourself some questions like, what am I trying to achieve with my investment? Will I need this money back shortly? How do I want to make with my money? Do I want to make it through dividends or price gains, or a bit of both? And how do I want to select the companies that align, or funds that align to my interests and values? So if you really want to make sure that you're building a sustainable portfolio, so businesses that are having a positive impact on the world, you might be looking for companies or funds that have that theme to them, or really care about that. So there's heaps of great ways that you can get this information from looking at Sharesies and description of the funds or what you search, or also seeing if the companies have integrated annual reports in terms of what they really care about. So I'll pass over to Gus too to talk a bit about how you do that due diligence and how you find out that information.
Yeah, so due diligence is a fancy word for research, and it's something you do to decide what you're going to invest in, or whether you're going to invest in something or not. So there are a lot of ways to do this due diligence, and it's really personal to you again. And you might be able to do things like Googling a company or reading its annual reports, which you can find on the website. Through this, you can understand the company's story, its strategy, how they're performing, who's in charge of the company. You can take a view on what the future might look like for the company. What do they have planned? Will they still be around in 10, 15 years? What are the big risks to the company? And also thinking around things like, what's the company's impact on the world? Do they have integrated reporting? Integrated reporting gives a holistic view of how the company is performing, not just financial metrics. And yeah, so there's no right or wrong answer to this due diligence, but it's about gathering in the info and taking a view on whether it's the right investment for you and your goals.
So yeah, essentially you've got this, everybody started somewhere, everybody started their portfolio or investing at some stage. It's simply just about getting started is the most important step. So, investing is an individual thing to each of us. So go enjoy it. There's heaps of resources that you can learn from. We provide some through podcasts like Lunch Money, where we interview listed CEOs, so you can get to know a bit about companies, or also we interview economists, and also recap, where every day we do a recap of the financial news that day. And so just absorbing that information and knowing that you can invest with amounts you can afford over time, and hopefully those are some interesting concepts for you. Thanks again for tuning in, and ka kite anō. See you next time.